So over the last 6 months, the main portfolio positioning change has been an increase in our exposure to mortgage servicing rights, and we're trying to get up to essentially 10% of the trust in that asset class. That asset class is very attractive in a rising rate environment. So as interest rates go up, particularly the 10-year, the 10-year U.S. Federal bond, then basically what happens is they become more valuable. So we've been adding to that position with the anticipation of all the stimulus, fiscal stimulus, that's going to affect market forces, which it has. In terms of our rest of our portfolio, about 85% is exposed to debt issued by banks and insurance companies, and we also have an emerging exposure to fintech debt situations. Those are more special situations that offer attractive returns. But the main thing to focus on in terms of our bank and insurance issued debt that we own the equity tranches of securitization, so we get some leverage on those, is that they are majority floating rate paper. So again, rising interest rates, that paper produces a higher return. So we're very pleased with the fact that the market is giving the trust a real opportunity to perform in a rising rate environment. The trust has performed very well recently over the last, 2021 we exceeded our public target performance of 8 to 10%, and we have done that on an annualized basis, exceeded that range since our inception, which was just shy of 5 years ago. So we're very proud of the performance. The other thing to mention about the performance is that we've also consistently issued our quarterly dividend. We've had no suspensions, no reductions of the dividends since our inception. And that, of course, encompassed the COVID-19 period where many of our competitors did suspend or reduce their dividends. So we've had a steady dividend payment, and that's very attractive at where the trust is currently traded. So it's about 8.5%. So it's very attractive based upon where the trust is trading, and it's a very steady dividend, and we feel great. We think that's an important part of our performance. The last aspect of our performance is really our underlying credits, primarily bank and insurance issued debt. We've had no defaults, we've had no deferrals of that underlying collateral. So the trust really exemplifies a real safe place to get a high risk return from the perspective of getting steady cash dividend vehicle in a trust format. Well, the key portfolio changes are really looking at a rising rate environment. You've seen inflation really take off in a tangible way. It's not transitory, it's real. I think the recent Russian invasion of the Ukraine, that really will continue to exacerbate inflationary pressures. And so I think what you want to be in is have exposure to, one, the U.S. market, because we're insulated largely from the impacts of that in many respects. The U.S. does not really rely on Russian gas or oil in any major respects. The second thing is, when you have these inflationary pressures and you have rising interest rates, you want to be exposed to interest rate sensitive assets, which we do have with our bank and insurance issued debt, as well as our mortgage servicing rights, all of which will rise in value as interest rates go up. Basically, banks are a defensive place to be when you're dealing with an inflationary period that we're living in right now. Well, of course, it's very hard to say that banks and insurance companies are exciting or interesting, but I will make the case that what's happening in the regulatory world as it applies to digital currencies, digital payment systems, blockchain technologies, particularly in the payment space, it is, from a regulatory standpoint, very interesting space. Why do I say that? Because we believe at EJF Capital that 2021 was a tipping point. The number of folks that own throughout the world digital currencies personally, the use of fintech technologies that banks are adopting as well, it hit a tipping point in 2021, and of course the regulators react to that, and they are starting to make the move towards increasing regulation in the digital payment space and in the stablecoin space in particular. So we think there's going to be increased regulation, and what that does, it gives you an opportunity to play the convergence between regulatory change and new technology. The way the trust plays it is in our emerging component of our portfolio that deals with lending to fintech companies. With the recent pullback in growth valuations, basically fintechs really, they need a lot of cash, but they don't want to do down rounds. So we can do bridges to them with equity kickers. We can also provide debt facilities that have very attractive yields, and again, equity upside. We can usually negotiate that. So we think this is a great time to be lending into that vertical, which is a very important vertical here at EJF Capital. We do manage assets and other vehicles in that space, so we know the fintech world well, and we also have great great deal flow in that space. Well, I think the key features of the trust is that you have one, exposure to U.S. assets. That's fairly unique in the investment trust world, available in the U.K. and Europe. Number two is that we're really, the trust is really a great way to play a rising rate environment. A majority of our assets on the bank and insurance issued debt are floating rate. Rates go up. Those interest rates and coupon payments go up, and then mortgage servicing rights. It's really, I don't think, it's a very unique opportunity for Europeans to play mortgage servicing rights in a vehicle. I think it's the only one that I'm familiar with that you can play it, and those are are negative convexity to rising rates. Rates go up. It's one of the few areas in fixed income essentially where you can get better returns, and we've had great returns in our mortgage servicing rights portions of our portfolio.